All right, so let's get started. If you have any questions, you're welcome to put them in the chat. Let's see, we do have a chat. Oh, recap room. Okay. Um, but otherwise, we'll open up it up for questions at the end if we still have some time. Okay, so uh first, I'm going to talk about, what to keep in mind when you are looking for credit, and what are some of the options you have available that will be better for your credit. So you definitely want to, before you commit to anything, you want to shop around. So if you're looking for a new credit card, you want to compare different banks, different credit unions or financial companies, or if you're looking for, an auto loan, for example, or a personal loan, you want to look at different dealers and what the offers are before you commit to any. You want to know the amount that you will pay in total, and this depends on several different factors. You might be able to negotiate a certain price, for example, for a vehicle, the annual percentage rate, which is the interest rate essentially, which sometimes may also be negotiable. Sometimes those terms are not negotiable. And then the length of the credit agreement. So, do you have to pay off the loan, for example, over a time period of 2 years, or is it a credit card where there isn't necessarily, a time restriction other than you have to make at least the minimum payment every month, or else you will go into default. And then you want to determine how much you can afford to pay. So you need to analyze your financial situation. How much do you have to spend each month for basic necessities, rent, mortgage, food, transportation, and then, how much money do you have coming in, obviously, and then are you going to have enough to both cover your monthly expenses and pay the credit card or whatever uh, arrangement you have, if it's a loan, are you going to have the money to pay that without falling behind? Sorry, my cat is interested in this presentation, I guess. And so it's important to, not agree to any credit card agreement or loan if you don't think you'll be able to pay it. That will end up putting you off in a worse position because it'll negatively affect your credit. And then you definitely want to read the contract before signing it, and verify that the terms are the same as what you expected. If the contract has additional terms, that you did not want, you should ask the dealer to remove them. Whoops. Sorry, just give me a second. My cord fell out. Just 1 minute. Okay. So, and this is important to keep in mind, for people who have a different primary language other than English. There's a law in California. It's called California Civil Code 1632, which provides that if a consumer negotiated a contract in a language such as Spanish, Tagalog, Chinese, Vietnamese, and Korean without using an interpreter, then the consumer is entitled to have that contract translated in their primary language before signing the contract. In violation of this law entitles the consumer to cancel the contract. This law does not apply to every single language, but I think like the main languages in California, I think there are like 9 or 10. Um, But if you want to learn more, you can go directly to the Civil Code 1632. So this is some more information about how you can compare different credit offers. Each credit card or loan offer should have what's called a Truth in Lending Act or TILA box, and it will give you information related to the annual percentage rate, which is the amount of money that the credit will cost you at a yearly rate. So that's essentially the interest rate. The finance charge, this is the dollar amount that the credit will cost you. So there's usually a charge when you sign up for one of these cards or loan, for example. The amount finance, this is the actual amount of credit that is provided to you or on your behalf. So if you take a loan out for $2,000, that would be the amount financed. And the total of the payments, this is essentially the sum of the annual percentage rate, the finance charge, and the amount finance. So this is the total amount you will have paid after making all the payments as scheduled. So here are some of the most common borrowing options. There's secured loans. So this, for example, is mortgages and auto loans. So what that means is that the loan has some sort of property attached to it, where if the person does not pay back the loan on time, then the lender has the ability, through legal processes to repossess the car or foreclose on the house. There are payday loans, which I'll get into more detail in a couple slides. But it's essentially a loan that consumers can get each payday, so every 2 weeks. There are definitely some concerning issues around payday loans to keep in mind. There are personal loans. So that is, for example, if somebody needs a loan to purchase some furniture, they could get a personal loan, and maybe it has like a year term and they have to make a certain payment every month. Credit cards, which I'm sure, most of you are aware of. There's something called lending circles, which is not as common, but it's essentially like it's a way for a group of people, usually they know each other, they're friends or family, um, and they essentially pool their money together. Let's say, for example, there are 10 people in a lending circle. They pool their money together. Maybe they each have to pay $100 each month, and then each month, um, one of them will get a loan for $1,000. Um, and it's usually interest free. And because in most lending circles, people know each other, there's more incentive to, follow through and make sure you make your payments. So it can be a good way to build your credit in an interest-free way. And then also some people borrow from friends and family, and borrowing from work, which is not something I've seen very often. So I'm going to talk a little bit more about secured versus unsecured debt. As I mentioned before, secured debt has an asset attached to it, some type of property. So that's usually a car or a house. Um, that's the most common. There's also secured credit cards, which the property is a person's bank account. So like checking account. Usually secured loans come at a lower interest rate than unsecured loans. However, if you don't pay back your secured debt, the lender can take the property as a payment for the debt. So for example, with mortgages, the lender can take your home, which is obviously would be a huge difficulty and hardship. Auto loans, that's what happens when a car is repossessed, and pawn loans. So if you take, property to a pawn shop, they can take that property. Um, then there's unsecured debt. So this type of debt does not have any property attached to it. So if a person falls behind on making their payments, the loan will go into collections. So some common examples are credit cards, department store charge cards, personal loans, and student loans. This is just kind of an example of some language that you will see in a secured um, agreement. So this is an auto loan agreement. So as you can see, it says you grant us a security interest in the vehicle and all parts or accessories, including the radio, tape player, etc., attached to the vehicle. All money or goods received for the vehicle and all proceeds are refunded. Insurance premiums or charges, etc., financed in the loan. So you definitely want to make sure you're clear on whether the credit that you are interested in signing up for is a secured arrangement or unsecured. And so again, this is just the language that you'll see in a secured loan. It says if you are in default, we may declare all amounts owed immediately due. So it can end up being quite uh, burdensome if you end up falling behind on an auto loan, for example, or mortgage. Because not only will they try to recover the property, but also they will demand all amounts due immediately. So you definitely want to make sure, of course, also it's possible that something unexpected comes up, and there are ways to try to get some sort of negotiated payment plan if you do experience a hardship. Um, okay, so what are payday loans? Payday loans are short-term, high interest rate loans. And the title comes from the fact that the borrower writes a post-dated check to the lender, and the loan is paid on the borrower's next payday. So some examples are check and go, cash call. I need to, sorry, just 1 minute. Check and go, cash call, speedy cash, ace cash express. There are a lot of, just kind of, you'll see some of these payday loan companies on just driving, in downtown. So they are often predatory. So we definitely advise folks in general to think very hard before agreeing to a payday loan because there are a lot of negative consequences that can result. So just to give kind of a bigger picture reality about payday loans and the industry, approximately 12 million Americans spend $9 billion on fees for payday loans each year. Um, Although payday loans are advertised as being helpful for unexpected or emergency expenses, unfortunately, 7 in 10 borrowers use them for regular recurring expenses such as rent and utilities. And it's problematic because it becomes sort of a debt trap where the consumer has to take out a payday loan each pay period to pay the past payday loan. So it gets it becomes a cycle of debt that is hard for consumers to get out of. So most borrowers cannot afford to pay for basic expenses after repaying a payday loan. The CFPB, which is the Consumer Financial Protection Bureau, which is a United States agency, found that 80% of borrowers take out another loan within 2 weeks of repaying the payday loan. So this is reflective of what I said earlier in regards to payday loans ending up being kind of like a cycle of debt that consumers get trapped into. Payday loans are not price competitive. So most lenders are allowed to charge the maximum fees allowed under law. They're easier to get because one's credit is not reviewed before the payday loan is granted to the consumer. Um, 3 out of 4 payday loans go to people who take out 11 or more loans each year. So the industry relies on these repeat rollovers for fees. Another reason why the payday loan industry is burdensome often is because, as I mentioned, they can charge the highest amount. They can charge a large amount of interest. And then in California, the max loan amount for a payday loan is $300. The maximum fee is 15%, so that's $45 per $300 loan. The payday lender cannot bring criminal charges for not paying it back. That's important to remember. We're not um, debtors' prisons are illegal now, so you can't be arrested for not paying your loans. If you do have an issue with a payday lender and you believe that it's the lender is being abusive or they've violated laws, you can contact an attorney, like someone from our office, to consult with, and then also potentially file a complaint with the Consumer Financial Protection Bureau. Um, excuse me. There's also California agency that can accept complaints for payday loan issues. So here's a sample Truth in Lending Act box for a payday loan. Um, this is a generous scenario of having 1 month to pay back a payday loan. As you can see, the annual percentage rate is extremely high, 211%, almost 212%. The finance charge, so again, that's the amount that you have to pay, the fee essentially. So that's 15% of the total loan amount. The amount financed is $255, and then the total of payments is $300. So that's the finance charge plus the amount financed. So this is some more information about the payday loan debt trap. So for example, it starts the financial institution approves a person's loan application. Well, first the person applies for the short-term loan at an ACE location, so at a storefront, essentially. Then the bank approves it. Then the customer exhausts all the cash and does not have the ability to pay the loan back. Um, then the ACE, the financial institution contacts the customer for a repayment or offers the option to refinance or extend the loan. Then what happens is the customer does not make a payment, and then the account enters into collections. And then so essentially the consumer has to take out another loan to pay back the loan that that went into collection. So it becomes a cycle and a debt trap. And you also want to be aware of other financial products that are marketed as payday alternatives. So for example, the CFPB found that this company LendUp marketed their product called the LendUp Ladder, claiming that consumers could progress to loans with lower rates and longer repayments while improving credit. The products were not available to consumers when advertised, and um, the excuse me, the financial company did not report information to credit bureaus. So, if a person is paying their loans on time each month, or their credit card, that should obviously be reported to the credit bureaus, because it will um, help improve your credit score. Um, so the Consumer Financial Protection Bureau ordered LendUp to pay 3.63 million for failing to deliver the promised benefits of this product they called LendUp Ladder. So you want to be very cautious with some of these companies that we've seen particular abuses become common. So LendUp, Springleaf, and Opportune are some companies you definitely want to talk to a lawyer before agreeing to any agreement with these companies. So what is the difference between a payday loan and a personal loan? So personal loans are similar to payday loans in that they are small dollar, high interest loans. However, there are a few important differences. Payday loans often have smaller loan limits, just a few $100s, versus personal installment loans, which usually have a few $1,000s as the limit. Payday loans have shorter repayment periods, usually within a few weeks. Personal loans have longer repayment periods, so usually it's several months, or it can be up to a few years. And with payday loans, the consumer often has to pay back the loan in one lump sum, whereas in personal loans, it's usually paid back in installments, such as monthly installments is the most common. And with payday loans, the lender doesn't have to check your credit. So that ends up being more abusive, because the payday loan company can charge these high interest rates, and these charge high fees regardless of whether or not the consumer can actually pay that. Which they would have some sense if they looked at the consumer's credit report. Um, so with personal and installment loans, the lender will usually check the consumer's credit report, and the loan terms may be based on their quote unquote credit worthiness. So, the credit score, and what the lender learns from the credit report. So personal loans, there are rate caps in California. Prior to 2020, only loans under $2,500 had interest rate caps. Loans over $2,500 did not have interest rate caps, so lenders would charge whatever interest rate they wanted, which obviously is very can be abusive. For loans between $2,500 and $5,000, lenders would charge over 100% interest on more than half of. There is a new law now, thankfully, in California, which started on January 1st, 2020. And it says that for loans 2,500, the same rate caps apply. For personal loans between 2,500 and 10,000, the interest rate is capped at 36%, plus the federal funds rate, which is around 2% per year. So this is just another example of comparing two different Truth in Lending Act boxes. So for example, on the left, or it's left of my screen, with the colorful lollipop, you have banks and credit unions, and on the right, this is a check cashing store. So we're gonna look at these two loans, which have the same amount financed, $2,500, but different terms. And you'll see that with the check cashing store, the consumer will end up having to pay quite a bit more money than kind of a more standard loan with a bank or credit union. So with the bank or credit union, the interest rate is about 8%. The finance charge is $109, and again, the amount financed is $2,500, and the loan term is 12 months. So the consumer has to pay back the loan within 12 months. Their monthly payment ends up being $217 over a 12-month period. When you look at the check cashing store, again, it's a $2,500 loan, but it has a longer payment period of 24 months. However, the interest rate is extremely high. It's 100%, and the finance charge is $3,358, and the amount financed is still only $2,500. So the total number of payments become $5,858, and the monthly payment for 2 years is $244. So obviously, the loan on the left is a more affordable option. Oh, yeah. So this just shows the differences between each loan offer. So you want to be aware of relying on credit card debt. It's understandable because credit cards can be a convenient form of borrowing, and it provides a revolving line of credit, meaning each month you're not limited except by the maximum in your credit card, but you don't have to each month essentially be limited unless you are very close to the maximum allowed on your credit card. So most credit cards require a monthly minimum payments. However, paying the minimum payment, only the minimum payment each month can cost you more um, than you realize. So, for example, in this chart below, you can see that with a credit card balance of $6,081, if you pay the minimum amount each month, it's obviously going to take a lot longer to pay off the credit card, and you're going to end up paying a lot more in interest, so $4,000 approximately, and then the total owed is quite a lot more, 10,145, than if the person pays double the minimum payment each month, which will take only 5.5 years to pay off versus 14. And the interest is obviously a lot lower. It's about a third of the amount if a person only pays the minimum each month. So then the amount owed is, including interest, is less, obviously, than if a person only pays the minimum. And then if a person pays a minimum plus $100 each month, that will take them, of course, less time to pay. Approximately 3.5 years, and the interest, there's less interest, and the total amount owed is less. So it's only about $100 less than the minimum payment, but significantly less than only the minimum payment. So some things to consider when making your payments on credit cards. Only paying the minimum payment is the most expensive repayment option. However, paying the minimum payment is a lot better for your credit than falling behind and missing a payment. If you have several delinquent credit cards, it's better to bring as many accounts current as possible rather than to pay a little bit on each where they all stay delinquent. So you want to, as much as possible, move credit cards out of delinquency. You want to pay down your higher interest rate cards first, which will save you money in interest and fees. So I'm going to talk a little bit more about secured credit cards now. So I mentioned this a little bit earlier, but So a secured credit card works essentially like a normal credit card, but the property attached is money in your bank account. So you can make purchases, no more than 30% of the credit line, and you should pay off the full credit card balance each month. And then you make a deposit into your bank account, which that deposit is the security for the secured credit card. So it's the property. Maybe you um, give a deposit for $1,000, so that $1,000 would end up being the secured property if you fall behind on making your payments on the credit card. So after positive credit behavior, if you pay everything back, on time, and in full, then the deposit is released back to you. So these types of credit cards are a good way to begin building credit, if you don't qualify for a regular credit card. Oh, so that is the end of the presentation. This is some more information about HERA in general and the types of services we provide. We help folks out with a range of debt collection issues, including student loans, auto loans, medical debt. Some of the loans we've talked about today, homeowners association debt issues. We also help with credit reporting issues, helping people correct errors on their credit report, dealing with identity theft. Again, we help folks with, assessing financial products, and choosing good credit building options for themselves. We also have a home ownership team, which helps with foreclosure and mortgage issues. We also do help veterans and service members. This is missing from this slide, but we help tenants. We have a tenant team. We help with a range of different tenant issues, except eviction defense. So we can help with landlord disputes, habitability problems, discrimination, Section 8, dealing with public housing authorities. We also have an estate planning team that can help with simple wills, trusts, health directives, and powers of attorney. All of our services are free except the estate planning team, which does have a sliding scale. But I believe that if you cannot, you don't have substantial enough income, we will still provide help for you, even if you cannot pay. So I'm happy to answer any questions about what we've talked about today. If anybody has some, you can put them in the chat. I think you should be able to. Let me just see here. Michael, do you know, can they put questions in the chat?
Thanks, Nasia. So we do have one question, which is the CFPB still operating and accepting complaints?
Yeah, that's a good question. It's obviously with a new administration, folks are not going to get the type of service we got with the Biden administration. I believe they're still operating, but it is not clear that they're actually, responding to complaints. So if you do want to make a complaint, I'd suggest actually going to the California Department of Financial Protection and Innovation. If you have some sort of credit or debt collection complaint. It can be challenging if there isn't really a California specific issue, but it's still worth it to make a complaint. And this is something that we are monitoring. So you're definitely welcome to call. I think our phone number is down here on our website, and we have an email address that you can reach out to us if you have some questions about the CFPB and whether or not it makes sense for you to file a complaint. So yeah, you're definitely welcome to reach out to us to schedule an appointment with an attorney. But yeah, that's definitely something we're monitoring. And it kind of depends on the issue. But it does make sense to, for now, go to the California Department of Financial Protection and Innovation rather than the CFPB. Okay, any other questions?
Just a follow-up question, which is, so is the Consumer Financial Protection Bureau federal?
Yes.
All right. So yeah, that is it as far as the questions
Okay.
go.
Um, I can happy to wait a few more minutes if anybody thinks of any other questions. Michael, maybe you can, for some reason I'm not, oh, here it is. I'll just enter this into the chat. So that's the California agency that you can file a complaint with.
Definitely. And then just one more question just came in through, which is where can you get a secured credit card?
That's a good question. I would check with local, I don't know if you have a credit union or a bank. I can't provide direct specific like advice. But you can also go to our website. We have um, a web page called Money Happy. Michael, do you think you can put the link in the chat box by any chance? Do you know what I'm talking about?
Yeah, absolutely. So Hera has some information on its website about kind of what Misha was talking about. For anyone who's interested, they can access the link in the chat right now.
Yeah, so that will give you the option to search by locality to see what options there are in your region. And it doesn't necessarily have to be limited to where you live. And then you're also welcome again to just call us and potentially get set up with an attorney to get some more advice about how to find a secured credit card. Okay, any other questions?
No other questions at this time.
Okay, so I believe this is being recorded. And if you would like the slides, feel free to reach out to us. Let me see here. Maybe we can give the inquiries email, Michael. So inquiries at heraca.org if you would like the slides. Um, okay, well, thanks everybody. If there are no more questions, we can wrap up